Hello students, welcome to EPJ Pathshala. I am Navina Thakur from Department of Commerce. Today we are going to talk on a module vertical versus horizontal and internal versus external financial analysis under the paper accounting and financial analysis. Learning objectives. This module outlines a comprehensive framework for financial statement analysis. The objective of this module is to extract the information relating to financial statements, to know how the various techniques like trend analysis, common size statements, and comparative statements used. The goal of financial analysis is to use financial data to evaluate current and past performance of a firm and to assess its sustainability. There are two important skills related to financial analysis. First, the analysis should be systematic and efficient. Second, the analysis should allow the analyst to use financial data to explore business issues. The analyzing of financial statements depending upon various factors like first, the material used, the second, the methods of operation. Tools and techniques used in financial statement analysis. Very few numbers in financial statements are significant in themselves, but we can draw meaningful inferences from their relationship to other amounts or their change from one period to another. The various tools of financial statement analysis help in establishing significant relationships and changes. Financial statements indicate certain absolute information about assets, liabilities, equity, revenue, and expenses of an organization. They are not readily understandable to the external users, so analysts need to adopt various tools and techniques to make it useful to the third parties. A financial analyst can adopt the following tools and techniques for analyzing of the financial statements. First, comparison of financial statements. Second, common size financial statements. Third, trend percentages. Fourth, ratio analysis. Fifth, fund flow statement. Sixth, cash flow statement. Comparative financial statements. These statements for different period of time are known as comparative financial statement. It is important to compare the financial statement of 2 years to draw conclusion, and this statement serve the purpose. The comparative statement of income statements enables to review the operational performance and to draw conclusions, whereas the balance sheets presenting a change in the financial position during the period show the effects of operations on the assets and liabilities. The comparative statement may show first absolute figures, the true values. Second, changes in absolute figures. It may be positive or negative. Third, absolute data in terms of percentages, degree of percentage. Fourth, increase or decrease in terms of percentages, positive or negative. The types of comparative statements can be classified in two forms, which are discussed as follows. First, comparison of balance sheet. It is necessary to study the trend of the same item, groups of items of the same business enterprise on different dates. Second, comparison of income statements. It gives an idea of the progress of a business over a period of time. Comparison of balance sheet. Studying the trend of the same items, group of items, and computed items of the same business enterprise on different dates is the concept of comparative balance sheet. The changes in periodic balance sheet items reflect the conduct of a business, that whether the business is rising or falling, and changes can be observed by comparison of the balance sheet at the beginning and at the end of the period, and those changes can help in decision making. The comparative balance sheet has two columns for the data of original balance sheets, and third column is used to show increase in figures. While interpretation of the information contained in the company's balance sheet, certain guidelines need to be followed. The following aspects are expected to study while interpreting the comparative balance sheet. First, a student should see the working capital. Working capital is the capital which is required to meet the daily expenses. In both the years while studying financial position of a concern, this will enable them to analyze the current financial position. Second point, the second aspect in order to understand the financial position of the company is to study the liquidity position of the concern. Third point, to frame wise policies to finance fixed assets, it is important to study the long-term financial position of the concern. Comparison of income statement. The income statement of the company provides information about a company's performance over a certain period of time, although it does not reveal much about the company's current financial condition. It does provide indications of its future viability. The main element of the income statement are revenues earned, expenses incurred, and net profit or loss. Revenues consist mainly of sales, though financial analysts may also note the inclusion of royalties, interest, and extraordinary items. The income statement, having been termed as profit and loss account, is the most useful financial statement, as profit and loss account is prepared to know the net profit earned by the company during a particular period or net loss bear by the company during a specified period. The figures of various items for 2 years is to be shown on first two columns. Third and fourth column are used to show increase or decrease in figures in terms of absolute amounts and percentages respectively. There are certain guidelines which helps in interpretation of data contained in income statement of the company. The following aspects are required to study while interpreting the comparative income statement. First point, the increase or decrease in sales should be compared with the increase or decrease in cost of sale. Cost of sale can be calculated by deducting gross profit from net sales. Second point, the next step of analysis is to study the concept of operational profits. Third step, the increase or decrease in net profit will give an idea about the overall profitability of the concern, as it helps in deciding the dividend policy for the concern. Next point, to calculate the figure of net profit, all the non-operating expenses are to be excluded from operating profit. Next, it is important to put opinion about profitability of the concern, and it should be given at the end to conclude whether overall profitability of the firm is good or bad. Types of financial analysis. On the basis of material used, financial analysis can be of two types, that is external analysis and horizontal analysis. On the basis of modus operandi, the financial analysis can be of two types, internal analysis and vertical analysis. First, horizontal analysis. Comparison of financial data of a company for several years is the concept of horizontal analysis refers. It is also considered as a simple approach to financial statement analysis. Horizontal analysis spotlights trends and establishes relationships between items and appear on the same row of comparative statement, thereby disclosing changes on items in financial statements over time. Horizontal analysis can also be considered as dynamic analysis because dynamic analysis is based on the data from year to year rather than on data of any one year. This analysis makes it possible to focus attention on items that have changed significantly during the period under review. The best examples of horizontal analysis are comparative financial statements and trend percentages, as it involves analysis of financial statements for a number of years. According to material used, financial analysis can be of two types, which are discussed as follow. First, external analysis. This analysis is done on the basis of data published by outsiders such as stockholders, banks, creditors, and general public. The external analysis serves only a limited purpose. However, the recent changes in the company regulation, in which it is mandatory as per Companies Act 1956 to make available more detailed information to public through audited published accounts, have considerably improved the position of external analysis. Second, internal analysis. This analysis is operated by the person of the organization within. In other words, internal analysis is done by persons who have access to the internal accounting records of a business. Such analysis can therefore be performed by executives and employees of the organization as well as government agencies which have statutory power vested in them. The objectives of such analysis is to provide the information to the top management so that effective decisions can be taken and financial position of firm can be improved. The financial analysis can be of two types. The criteria are modules operandi. First, horizontal analysis. Comparison of financial data of a company for several years is the concept of horizontal analysis refers. It is also considered as simple approach to financial statement analysis. Horizontal analysis spotlights trends and establishes relationship between items that appear on same row of comparative statement, thereby disclosing changes on items in financial statements over time. Horizontal analysis can also be considered as dynamic analysis because dynamic analysis is based on data from year to year rather than on data of any one year. This analysis makes it possible to focus attention on items that have changed significantly during the period under review. The best example of horizontal analysis are comparative financial statements and trend percentages, as it involves analysis of financial statements for number of years. Next, vertical analysis. The study of relationship of various items of only one accounting period is the concept of vertical analysis. In this type of analysis, financial ratios are to be calculated for 1 year. It is also called as static analysis. The two tools employed in this analysis are common size financial statement and financial ratios. It is very conducive to a proper analysis of financial statement because it considers the data only for one time period. However, it may be used along with horizontal analysis to make it more effective and meaningful, as alone it considers the data of 1 year only. Vertical analysis involves the conversion of items appearing in statement columns into terms of percentages of base figures to show the relative significance of the items and to facilitate comparisons. For example, individual item appearing on the income statement can be expressed as percentages of sales. On the balance sheet, individual assets can be expressed as a percentage of total assets. Liability and owner equity accounts can be expressed in terms of their relationship to total liabilities and ownership equity. Trend analysis. It is also one of the important tools of horizontal analysis. Trend analysis, as it is clear from the name only, it is useful to check whether the financial position of a business entity is improving in the course of time or it is deteriorating. It involves calculation of percentage changes in financial statement itself for a number of successive years. Procedure of calculating trends. First, generally, the first year is taken as base year. Second, the figure of base year are taken as 100. Third, trend percentages are calculated in relation to base year. Note, it should be remembered that the base year should be an if base year is a normal period because the entire results are based on the base year only, as all the other years data is divided by the base year only, and if base year is not normal, then result will come insignificant. This method determines the direction upwards or downwards and involves the computation of the percentage relationship that each statement item bears to the same item in base year. Generally, the first year is taken as base year and figures of base year are usually taken as 100, and trend ratio for other years are calculated on the basis of base year. The question is required to be taken by the analyst, while interpretation of trend analysis as mere increase or decrease in trend percentage may give misleading results. For example, new company has a net profit of rupees 3 lakh, rupees 4 lakh 25,000 and rupees 6 lakh 40,000 respectively for 2012, 2013 and 2014 and 2012 as base year. The trend percentages for the company's net profit are as follows. Index in 2013 will be equals to 2013 sales divided by 2012 sales multiplied by 100 will be equals to 4,25,000 divided by 3 lakh multiplied by 100 will be equals to 142. Next, index in 2014. 2014 sales will be divided by 2012 sales multiplied by 100, that is 6,40,000 divided by 3 lakh multiplied by 100 will be equals to 213. Vertical analysis. The study of the relationship of the various items of only one accounting period is the concept of vertical analysis. In this type of analysis, financial ratios are to be calculated for 1 year only. It is also called as static analysis. The two tools employed in this analysis are common size financial statements and financial ratios. It is not very conducive to a proper analysis of financial statement because it considers the data only for one time period. However, it may be used along with horizontal analysis to make it more effective and meaningful, as alone it considers the data of 1 year only. Vertical analysis involves the conversion of items appearing in statement columns into terms of percentages of base figure to show the relative significance of the items and to facilitate comparisons. For example, individual items appearing on the income statement can be expressed as percentages of sales. On the balance sheet, individual assets can be expressed as a percentage of total assets. Liabilities and owners' equity accounts can be expressed in terms of their relationship to total liabilities and owners' equity. The two-column tool employed in vertical analysis generally are: first, common size financial statement; second, financial ratios. Common size financial statements. The common size statements, balance sheet, and income statements are shown in analytical percentages. The figures of financial statements are converted to percentages. A. It is performed by taking the total balance sheet as 100. B. The balance sheet items are expressed as the ratio of each asset to total assets and the ratio of each liability to total liabilities. Thus, it shows the relation of each component to the whole, hence the name common size. The common size financial statements are of two types, which are discussed as follows. First, common size balance sheet. Second, common size income statement. Common size balance sheet. A statement in which balance sheet items are expressed as the ratio of each asset to total assets and the ratio of each liability is expressed as a ratio of total liabilities is called common size balance sheet. It can be used by different companies of different size for comparison. The comparison of figures in different periods is not useful because total figures may be affected by a number of factors. Common size income statement. The items in income statement of common statement can be shown as percentages of sales to show the relation of each item to sales. A significantly relationship can be established between items of income statement and volume of sales and is helpful in evaluating operational activities of the enterprises. Distinguish between horizontal analysis and vertical analysis on the basis of accounting period. Horizontal analysis requires comparative financial statement of two or more accounting periods, whereas vertical analysis requires a statement of one period only. Second point of difference on the basis of items. Horizontal analysis deals with same item of different periods, whereas vertical analysis deals with different items of same period. Third point of differentiation, pattern of information. Horizontal analysis provides information in absolute and percentage forms. Vertical analysis provides information in percentage for money. Next point on the basis of usefulness. Horizontal analysis is used for the series analysis. Vertical analysis is used for cross-section analysis. Difference on the basis of comparison. Horizontal analysis is one of the part of comparison. Vertical analysis is a step towards comparison. So students, let's summarize what we have learned in this module. Financial statements provide the most widely available data on public corporations, economic activities, and other stakeholders to assess the plans and performance of firms and corporate managers. Horizontal analysis and vertical analysis of financial statements are additional techniques that can be used effectively when evaluating a company. After studying various types of financial analysis, an opinion can be formed about the financial position of the concern, as one cannot say if short-term financial position is good, then long-term financial position will also be good and vice versa. While using trend analysis, it should be keep in mind that accounting procedures and conventions used for collecting data and preparation of financial statements should be similar, otherwise the figures will not be comparable. Thank you.